Hello, welcome to the Invest Doc YouTube channel. I am Dr. Kenyon Meadows. Thanks for taking the time to hang out with us today, however you may be accessing this on YouTube, Facebook, or maybe you found our blog at theinvestdoc.com. On this channel, we are about income investment education. So I'd like you to please take a moment, if you could, to like, share, and subscribe. And we're going to get into our first topic. So what is income investing? Well, income investing is defined as a strategy where the goal is to accumulate a portfolio of assets that provide reliable, steady income. And for me personally, this has mostly been in the form of owning cash flowing rental property, dividend paying stocks, and even some conservative options trading strategies. So that will form the bulk of the content on the channel. But of course, we want to be interactive and responsive to our audience. So if you have questions, topics, concerns, and if I happen to have any insights into them, we will certainly respond to those as well. So with that being said, we want to jump into our topic today: real estate investing on any budget. Introduction to Real Estate Investment Trusts, abbreviated REITs or REITs. Now, I have to say up front that I think the best overall asset class is the direct ownership of cash flowing real estate, as it provides, in my humble opinion, the best mixture of returns, control, the ability to use leverage or the prudent use of debt to amplify your returns. And it has some pretty powerful tax benefits baked in as well. So I would encourage you to pick up a copy of my ebook entitled Buy Your First Rental, which you can get by clicking on the link down below. And it also places you on our email list. And you can, of course, respond with questions on there. And in the ebook, I talk specifically about the kinds of single family rental homes that I like to buy in terms of the price, how we renovate them, the type of neighborhoods, demographics we look for, and we'll also give you some details on the financial performance of those properties with actual numbers. So I think you'll find it quite helpful. And again, that's my favorite asset class, but let's be honest. Inevitably, when I start to talk about all the virtues of the direct ownership of cash flowing real estate, I get two usual objections. Number one is money. And to be upfront, it does take some substantial capital to get into the rental business, usually on the order of several $1,000s as a down payment. And of course, you have to have some additional money in reserve for some of the inevitable big ticket items and expenses you have to cover, like repairs and if there's vacancy for a prolonged period of time. And so this is very true. We do cover some ways in which to mitigate against that in my ebook, but over time, you will have to deal with these issues. Now, assuming you've got the financial side of things covered, some people don't want to deal with the time and hassle, however minimal it might be, with ongoing management of the property. Even if you hire a good property manager, they are going to need to interact with you sometime to get some direction on certain issues, such as to get authorization on certain repairs that are above a certain price threshold, or if you want to push ahead with an eviction on a tenant that's gotten behind on their rent. You know, those kind of executive decisions you will have to be a part of, okay? And some of them will even ask you to weigh in on things like the tenant screening process, ask you for your input on whether to raise rents, things of that nature. Now, some people like myself, I like that. It's a degree of control. It's a degree of involvement that I don't mind it. But, you know, the direct ownership of rental property is not for everybody. OK, so with that being said, there is another way to get some exposure to real estate without direct ownership. And that brings us to our topic, these real estate investment trusts. So what is a real estate investment trust? Well, I think everyone that's watching the video is familiar with the general concept of a stock, you know, fractional ownership in a publicly traded company. And REITs are essentially the corollary of that in real estate, in that you are buying fractional ownership in a publicly traded security that holds a bunch of income producing properties. And just like there are various sectors when it comes to describing the typical stock market, like healthcare stocks, technology stocks, consumer goods stocks, when it comes to REITs, they also have various sectors like healthcare, industrial, self-storage, apartments. So there's a lot of parallels there. Okay. So let's go through a simple comparison of a stock and a REIT, and we'll use one from my actual portfolio. Okay. So Apple, just Apple Hospitality REIT. Okay. Not Apple stock. Everybody knows about Apple stock. It's usually in the running for the most valuable corporation on earth. They make all the wildly popular consumer electronics, the iPhone, AirPod. Everybody knows about Apple. Apple stock is one of the most liquid and highly tradable securities on earth. But not many people know about Apple Hospitality REIT. Okay, so this is a REIT that owns a lot of the more well-known hotel brands, such as the Marriott, Hilton, and Hyatt. Okay. So this is now for a relatively modest price of $16. Okay. You could buy fractional ownership into these income producing hotels. Okay. And one of the characteristics about REITs is that by law, they have to pay out 90% of their profit that they make to shareholders. So they're very much a favorite amongst income investors like myself. Okay. So just like I get a monthly check from a tenant from a single family home, I can get a monthly dividend payment, as it were, from the REIT. And these are derived from hotel guests staying at the facilities. Okay. Unlike getting a check from my rental property, though, I never get a call from the property manager asking to deal with a tenant issue or a repair issue. Okay. Additionally, the money required to get into a REIT, as you could see, this particular REIT was very modest at $16. And you could even buy like one share to get started. And now that we're in this era where commissions are essentially zero, and they always have been on the Robinhood platform, which is one of the main platforms I use, the barrier to entry is very, very low. So you can, with a few pushes of a button and opening up your account, you can be a real estate investor in every sense of the word. Although, again, these does not have all the advantages of direct ownership. Okay. Now, what are some of the pros and cons of being in REITs? Well, diversification. So unlike buying a single stock, which some people can get nervous on when you're exposed to all the risk of being too concentrated in one stock. Even if you buy just one REIT, you're actually automatically buying a whole number of income producing properties. So in the example of Apple Hospitality, if a particular hotel is not doing very well, there are dozens of others in the portfolio to pick up the slack. And that helps make me more comfortable with picking out individual REITs. Okay. Liquidity. This is huge. If I wanted to sell a cash flowing rental property, that takes a while. You have to, generally speaking, if you're selling to somebody, they may need to get financing from a bank. That takes time. There's required inspections and appraisals, things of that nature. And so, on the fast end, and I'm talking lightning fast, a cash buyer who wants to buy a property off you, you could get it done maybe in as soon as 2 weeks, but usually it's much, much longer than that. Conversely, if you owned a huge portfolio of REIT stocks, even if you had hundreds of thousands or millions of dollars worth of REITs, you could liquidate that and turn it into cash with just a few keystrokes anytime the market's open. So now for me, when I buy these, I buy them and I plan to hold them for a long period of time. So it's not a huge deal for me, but it's a nice bonus to know that you can exit these positions very quickly. The other thing is exposure. And when I say that, I mean, just like getting the money together to buy even one single family home can be quite a financial hurdle. Well, multiply that times 100 if you're talking about trying to participate and own a 100-unit apartment complex, or a large self-storage unit, or an industrial warehouse, things of that nature. Okay, so REITs allow you, the average investor, to participate and have exposure to some of these other asset classes that otherwise would be, I mean, virtually impossible unless you were a very, very wealthy individual and can participate in what are called private syndications, where money is raised from wealthy individuals, and they can participate in some of those things. But for the average Joe, you otherwise would never have exposure to this. So that's very good. Now, what are some of the cons? Okay. Debt dependent. They're highly, highly debt dependent companies. See, when an Amazon or an Apple, when they have a profitable quarter, they may pay out some of that money in dividends. A lot of times they don't. And certainly they don't pay 90% of their profit out to dividends. They can retain some of those earnings to buy out a competitor, do more marketing, do some research and development. REITs, because they have to pay out 90% of their money to their shareholders, and by the way, they do this to avoid being taxed at the corporate level. And you, as the individual shareholders, we bear the tax burden for that. So whenever they want to do anything, they have to borrow money. And so they are very, very sensitive to interest rate climates. So when interest rate starts to go up, their borrowing costs go up, and that can be very stressful. And so REITs have to maintain a prudent use of leverage and not get too over leveraged. We all know what happened with the 2008 mortgage crisis. Okay, so that's something that is that's just a shortcoming of the model there, but they all have that limitation. And as I mentioned before, they're relatively tax inefficient. And what I mean by that is, if you hold a regular stock that pays you a dividend and you hold that stock for more than a year, the dividends you receive are oftentimes taxed at the lower long-term capital gains rate. And this is not always uniformly the case for the dividend payments you get from REITs. There's a lot more instances where that those returns may be taxed at your normal tax rate. And so they are generally not as good in that regard. And so a lot of times people will advocate that you hold these in a tax favored account, a retirement account, for instance. So that's one of the other cons. But, overall, again, if you want exposure to real estate and you don't want to go out and find your property, find a property manager, and deal with those extra time and money commitments that go along with it. Again, REITs are a cool way to get into the game. And so we'll do some more videos profiling some other REITs and talk some more about it. Again, I really want you to join our email list with our ebook down below. If you have questions or comments, leave them below. If they're particularly good, we will do a video response to them. And we look forward to talking to you on the next video. Thanks.